Welcome to Missing the Mark, where we look for meaning in strange places. I'm Christopher. Today I'm going to talk about the stock market, by which I mean the American stock market, and why it makes sense that it makes no sense. So, and the super brief answer is it's going to be for historical reasons. But, so to explain the stock market, it's kind of a curious thing, and it really doesn't make much sense, which was driven home to me the other day when I was explaining it to my oldest son, who's 10 years old, and it was very confusing to him because it doesn't make sense. And that's for good reason, because its current configuration is not, in fact, sensible. It's because of historical contingencies. So I'm going to explain that and sort of how we got to where we are, and so why it sort of makes sense as it is. To start off, though, real briefly, if you don't know what stocks are, stock is a fractional portion of ownership of a company. So, to do a real simple example, if a company, usually the simplest version is when it gets going, to get its initial funds with which it's going to do business, it might sell 100 shares. And if you own one share in this company, the money goes to the company to use to pay people and buy equipment and raw materials and so on. So if you buy a single share in that company that issued 100 shares, you own 1% of the company. What does that entitle you to? What does owning 1% of the company mean? Well, it means, one, if the company were to dissolve, you get 1/100th of however much money the company receives for all of its assets when it dissolves. And two, if the company takes a portion of its profits and distributes it to the shareholders, known as a dividend, you get 1/100th of the amount of money distributed. Works the same way for however many shares. And in practice, a company can later raise more money by selling additional shares, although this dilutes the ownership of the current shareholders. And so this sort of thing doesn't happen too often, and in general requires the approval of the shareholders. Corporate governance, by the way, works from the shareholders. The shareholders either directly vote or much more commonly, especially in publicly traded companies, is there's a board of directors that the shareholders vote to elect. Then the board of directors then helps to set policy and also chooses the chief executive officer or CEO. Okay, so that's the basis of what shares are. And essentially that's why you would want to have them. The company dissolving is not usually in your best interest as a shareholder. There are some exceptions to this that somewhat happens. Sometimes startups do this in order to get bought out and stuff. Okay, but that doesn't really apply to most of what's traded on the stock market, so let's forget about it. It is an exception, but it's an unimportant exception to the main purpose, because that's not most of what happens. So why in general would you want to own the company? It's for that dividend. And I'm talking now about basically how companies got started, where this actually... not that this was true 100% of the time, even historically, but especially in the inception of incorporated companies, what was the purpose of putting your money into this, of doing that fractional ownership? And that was the company would carry out business. This enabled a bunch of people to pool their money, and kind of critically in corporations, it also shielded them from liability. So the most money you could lose is the amount of money you would put into the venture. People couldn't then sue you for more. Okay, so you would then put your money in, and then the company would do business, and then as it made a profit, it would give you money back. And this would continue. So you pay your money in once, and you buy a fraction of the company, and then for many, many years, you would be, in theory, deriving a steady stream of income from the company as it used your money and other investors' money in order to conduct business and make more money, and then it distributes it to you, the shareholders. Okay, all well and good. That's sensible, nice and simple, makes sense. However, what inevitably happens is that there are times when you might want to sell. You might want to get out of this for one reason or another, and there's somebody else who wants to get in, and so they offer you money. And the way that things work in general is they can offer you whatever money they want to, and you can sell it for whatever money you want to. There are some exceptions about corporate bylaws and stuff, again, inconsequential to the majority of the market. There will be circumstances in which a person offers you far more money than you paid for your shares. The company has grown bigger. The company is doing better. It's paying larger dividends. And so the amount of money that it is worth to buy into this, the amount of money you can pay for a share and still make money may have gone up. Well, then you get a second bonus as the person who just sold. You have made a bunch of money through dividends, and now you're getting a windfall of not only you're getting your money back out, but you're getting some additional money because the company is doing better. Well, for various reasons, some of them tax reasons, as I said, I'm talking specifically about the American market, some of them not. What happened was the nature of the stock market changed over time to where it actually became preferable to make your money by putting money in and then pulling it out when the stock price has gone up. That this was something that a large fraction of investors preferred over getting dividends. This then, and this has been going on for a while, and there are various factors. One I like to point to is institutional investors. The majority of the stock market is not individual people who are putting money into the stock market. The majority of money in the stock market comes from what are called institutional investors, people who are managing funds of one kind or another. So, when you hear about university endowments, they tend to put this. They mix several other things like bonds as well, but they put a lot of their money into the stock market in order to make a return. And there is somebody who is in charge of managing this large portfolio that's not his; he's just paid to do it. It's an institutional investor. Again, people have all sorts of funds like mutual funds and IRAs, individual retirement accounts, and 401ks. The 401, that's referring to a section of the tax code. There's a particular type of account under Rule 401 subsection K or something to that effect. Where you put retirement money in that you will later take out decades later for your retirement. Again, a lot of this gets invested in the stock market. All that gets managed by somebody, and that somebody will be an institutional investor. The same sort of thing for the other one. Insurance is another big one. There's a lot of regulations on what insurance can invest in, although it's kind of true of most institutional investors. General funds and stuff, like if you've heard of hedge funds, similar sorts of things. These are all institutional investors. People give them money and then they're in charge of investing in it. And they have a strange set of incentives relative to what an individual investor has. So like I might buy some shares of a company and then want to own that for decades, either for, getting in dividends or simply as sort of a long-term investment to eventually sell off in this more modern one. Institutional investors are measured constantly by the value of their portfolio, and they're not really set up in a way where dividends would actually be very useful to them. Whereas the fluctuations of the price of stock is much more useful to their particular goals, especially to the goals of the institutional investor within the confines of the incentive system in which they are working. Which is the reason I bring that up is because the incentive system is not designed to produce an outcome, but given a self-interested actor, a set of incentives will produce certain outcomes, or at least favor certain outcomes over other outcomes. And so that's why you have to look at somebody who is trying to serve his own interests while being responsible. Most institutional investors, they're not crooks, they're honest people who are trying to be responsible, but they're looking at the incentives they have and trying to do the best for themselves, while doing, reasonably, by the people who have trusted them, but especially who are trying to maximize the incentives that they are given. Because in general, like if somebody is going to pay you more for doing something, you'll tend to do more of it. And if that's not really in their best interest, well, in some sense, hey, it's their lookout that they paid you more to do something, so you're going to do more of it. And to some degree, like, why are you second guessing the people who are supposed to be competent adults who have offered you more money for some particular thing? And so if you look at what all these incentives, because they vary from institutional investor to institutional investor, but if you look at them in the aggregate, they tend to favor relatively short-term returns. Generally, consistent returns tend to be better, and relatively short-term returns. And so when these people who have enormous voting power because of all the shares that they are controlling, when these people elect boards of governors, and when these people then, the boards of governors choose CEOs, what they really want is not dividends. Those don't really work well with those don't really work well for the sort of thing that they're doing. What they want is the value of the shares to go up. And so this affects corporate governance so that the corporations, because giving out dividends is an entirely optional thing. That's something the company can simply at any time decide to do. Usually the few companies who still give out dividends will do so on some sort of regular basis, like once a year or 4 times a year or something like that. But a company can simply choose to not give out dividends to its shareholders at all. It can simply take all of the money that is made and reinvest it into the business to buy more equipment and more raw materials and hire more people, and thus drive the value of the company up in value in some sense. And that is what investors tend to prefer, for the various reasons I'm not going to get into details on, but institutional investors tend to greatly prefer this over dividends. And so this is what companies do. So dividends are incredibly rare these days. They almost never happen. And so more or less the only way that anyone actually makes any money in the stock market is not the way this is supposed to work, where companies distribute the profits from the business endeavors that they're in, but rather it's this game of sort of hot potato, or somewhat analogous to hot potato, of you hold the stock for a while and then someone else buys it for more money than you, and then someone else buys it for more money from him, and then someone else buys it for more money from him. So if nobody actually derives any value directly from it, only from reselling it, where does anyone come up with the prices for this stuff? Well, there are two things. One of which is this is somewhat tied. If you look at the way that people talk about the valuations of these companies, because there are a lot of people whose business it is to give estimates for what would be a good price for this thing. Analysts, they're frequently called. And if you look at the way they analyze things, the arguments they make are generally about what a hypothetical person who would invest in this company for dividends, if the company were actually giving out dividends, would find it reasonable to pay for that company. No one does this, so it's purely theoretical, but it does provide a sort of anchoring effect so that the prices of stocks don't... They're tied to something in reality, because this analysis is based on things like revenue and cost and expenditure, general forecasts of the growth of the market, and so on. So there's a time to reality that keeps the target price from growing too quickly. The other thing that goes on is what you might call a distributed Ponzi scheme. Now, a Ponzi scheme named after Charles Ponzi, though he was not the first to come up with it. In roughly 1920, he had he developed something or other exchange company, I can't remember off the top of my head, in which he offered in theory, he was engaging in arbitrage and something having to do with postage stamps and such things. Or things related to postage stamps, essentially futures on postage stamps, what it amounts to. Futures, the ability to buy something in the future for a fixed price now. Anyway, in theory, he was doing that. In practice, what he was doing was when people would invest money, he would then use money somebody just invested to pay off somebody who invested earlier. And he offered wild rates of return. He would double your money in 90 days. Now, the problem with a Ponzi scheme, of course, is that this works as long as you're always doubling. If you can double the number of people investing every 90 days, you can always meet your obligations and everything is going well and everyone's getting a 100% return in 90 days. And it's fantastic. The problem, of course, is we live in a finite universe with only finitely many people who have money. And so you will run out of new investors, in which case everything comes crashing down and the last investors get completely shafted. Now, the thing about the Ponzi scheme, and you see Ponzi schemes coming up periodically, cousins of them, the pyramid scheme and so on. The problem, or the reason why they always come crashing down and relatively fast, is because the people who do this stuff are greedy, and so the returns are always huge and the time frame's short, because they're trying to get this over with, get as much money as they can as quickly as possible into the system so that they can then run and disappear to a country that doesn't have extradition laws. Most of the time. Every now and again, you'll find somebody who accidentally does this because they thought they had a real business and it turns out the real business doesn't work. Anyway, and then they cheat, and then they cheat more to cover their cheating and cheat more to cover their cheating. And then if they're smart, they flee to a country with no extradition laws. And if not, they spend a lot of time in jail. But, so the thing about the Ponzi scheme and why it fails so quickly is because the rate of return is so high and the time frame is so low. However, if instead of doubling your money every 90 days, you double your money once a year, so you have a 100% rate of return once a year, your Ponzi scheme will last a lot longer. I mean, the problem is in the modern context, this doesn't work because there are people like the SEC, the Security Exchange Commission, who's a branch of the government, who will come and who will find out that you're doing this and come and arrest you for it. So they have, presently you have to do this real fast. But if you bear with me for a second, if the SEC wouldn't do that, If you stretched out to a year rather than 90 days, your Ponzi scheme would probably last a number of years because it'll just take a while before you run out of money to pay people. Now, a very second important thing to consider in this thought experiment is if instead of 100% return on investment in 1 year, instead of doubling your money once a year, you only increased it by 10%. That is to say, I'll pay you 100 in 1 year. I'll pay you 110% of what you paid me. This would make the Ponzi scheme last way, way longer because far fewer people at any given time will really want to jump in. And so instead of your Ponzi scheme flaming out in like 6 to 9 months, maybe 6 to 12 months, your Ponzi scheme at 1 year and at 10% return will probably last a good, 5, 10, maybe 15 years. Because, if you're at least a little bit lucky, because the number of people at any given time who are trying to jump in isn't that huge. So you will tap out your potential market much, much slower as people start coming in, and more people come in, and more people come in, as sort of word of mouth spreads, as, a year later, people get their 10% return and say, like, hey, this is pretty good. And they tell a few friends, like, I had good experiences with this, you should try it too. It would grow. You get to the point where you flame out much, much more slowly. Now, remember the other thing I said is you can call it a distributed Ponzi scheme. The thing that makes a Ponzi scheme illegal is that there's a Ponzi, a Charles Ponzi. That's to say, a single person who is making these promises. A distributed Ponzi scheme, a term I invented so far as I know, a distributed Ponzi scheme is where instead of there being a single person, it is simply people noticing like, hey, I made 10% in 1 year buying this stuff and then selling it to somebody else. You should buy some of this and sell it to someone else too. And there's no, and the thing that sort of makes it a distributed Ponzi scheme here is there's absolutely no discussion of the underlying fundamentals of why this is growing 10% per year. Just like, hey, I made 10% last year, 2 years ago, I made 10% last year. I expect to make 10% this year. You should do that too. Now what you have is there's no single person who is making these promises to other people. There are just a lot of people who are coming to expect that this is going to work. And so they are sort of together making a Ponzi scheme because there's still no underlying value. There's just past growth predicting future growth. And it's still all being paid for by the people who are buying in at the higher price this year because they're expecting to sell at an even higher price next year. So why do I say that the stock market is largely a distributed Ponzi scheme? Well, because that's exactly how most everybody is doing it. They are just simply buying the stuff on the expectation that somebody else will buy it for even more, because historically people have kept on buying things for more and more. And the thing that keeps this distributed Ponzi scheme working for a long time is the fact that the prices that people pay for things are tied to something in reality by way of that way that the analysts are making predictions, are making evaluations, I should say, for what a stock is worth for the approximately nobody who is buying it on the principles that they are using. That a good target price for this sort of thing is roughly number of shares. 10 times earnings divided by number of shares or something like that. Like there are particular companies for which you'll see a formula like that. And so that growth in income will limit the growth in what people will pay for this stuff. And so the result is, in practice, the average stock goes up like somewhere between 3 and 5% per year. And since that's really common, there isn't a lot of pressure on any one given stock. And so there's this fundamental tying of the growth in the price and a fundamental, so that it's limited to, it takes a long time to grow a bit. And moreover, there are a lot of different ones at different rates. And so it does, sort of two things. One, it doesn't provide any, overly much pressure on any given one stock. And two, the other thing is when people do take haircuts because they bought it at a high price and now no one's willing to pay for it, a haircut being a term for losing some of your value, but not all of it. People do lose money in the stock market, but because it's not a huge amount of money, what happens is these things periodically readjust. And because there isn't a default of contract, which is the other problem with the Ponzi scheme, that he was promising you a particular return, he made a contract, in essence, that he would pay you a certain amount of money. He had this obligation. And so if he didn't, he essentially by defaulting, you could now sue him for it. Whereas in the stock market, if you lose money on the stock market, you have no one to blame but yourself. And so the whole thing doesn't come crashing down when somebody loses money. The first person who buys it for a certain amount and then has to sell it for less, they just say, ouch, or possibly, if it's particularly bad, jump out a window. But they don't have anyone to sue, and so the whole thing can't come crashing down. So the modern thing, which is essentially a distributed Ponzi scheme, is kept working largely by this being tied to, in theory, a company could start giving dividends, because, I mean, they can always just choose to at any given time, and people could actually start investing for the dividends, and in theory, if the analysts are correct, and they're probably not ludicrously wrong, the amount of money, the amount of money you would get in dividends would be pretty reasonable. So, like, over a 10-year stretch, you would make a pretty good, like, return on it, given how much that you paid for it, in dividends. And so it's essentially a distributed Ponzi scheme in which it is kept going because these things are convertible into something of real value. And because they are convertible into something of real value, that is to say, the companies that are being partially owned could turn and start actually giving dividends. Where the particular prices of the stock lie relative to how much dividend they actually could give out varies. Amazon, for example, as I understand, is terrible in that regard. Like, Amazon essentially has, like, effectively never made money. And if they were to start giving out dividends, they basically give out no money. So you never really, but Amazon is kind of a weird side note. But for an awful lot of companies, especially stable ones like steel producers or IBM or, Kraft Foods or things like that, like, you could, if you wanted to, just say, like, okay, as a shareholder, I don't want you to try to pump up the stock price anymore. I want you to start giving dividends instead. And if enough shareholders actually want to do this, you could actually start extracting money from the companies. And so this is to some degree what ties this distributed Ponzi scheme. It restrains it enough that it doesn't go out of control and collapse, because there is a real value you could convert these things into. You might lose some money, but you wouldn't lose all your money on this. And at the same time, it also has the effect of keeping things capped, so the growth isn't unsustainable. You'll notice that growth of like 5% is actually remarkably close to like what the population growth of the world is. I mean, it'll vary, but it actually, in the United States, it's pretty close actually to the population growth of the United States. And that's really good, actually, because since the population is growing, the number of people there is to buy and stuff is being kept somewhat close to the number of additional people you need. And so, and that actually ties in a little bit, too, to if you were to convert to dividends, the growth of markets and so on enables a company to make additional money to pay additional dividends. So, for various historical reasons, what we have is a completely nonsensical distributed Ponzi scheme that, because it has these sort of tenuous ties into reality, into things that do actually have some value for real, nobody uses them in that way. They're not treated as if they have that value. Nobody actually, really wants that value. But because there is that theoretical value, it sort of keeps the system in check such that it doesn't turn into this runaway thing that just flames out and everybody goes broke, except for the few people who are in prison, who then go to prison. So that's sort of why it actually keeps on working, and why this completely nonsensical system is the way it is, and why it actually does kind of make sense. So, if you're interested in why this crazy thing actually works, I mean, it's one of those things that works unless it doesn't, but basically it works in practice, as well as most things in this world of sin and woe do. And so that's why we're in this weird state that we're in, and why this weird state just keeps on going and doesn't completely flame out and completely just burn like the way a typical Ponzi scheme does. So it's, as I said, just to super briefly recap, there's a tie to reality. There's no single point of failure, like when you have a Charles Ponzi. And because of that second one, you also have a built-in system of corrections where people periodically lose some money. And so the system, instead of just building up a giant amount of pressure that then just blasts everything apart, periodically lets off some of that pressure by people losing money. So that's sort of why it actually, despite being completely crazy and nonsensical, works anyway. Until next time, May you hit everything you aim at.